Welcome and thank you for joining us for this session of Wide-Moat Investing Summit 2013. It's a pleasure to introduce Koon the Managing Director of Bamboo Innovator Institute in Singapore. KB has a very instructive framework for finding undervalued wide-moat businesses across Asia. It's a framework that he refers to as the Bamboo Innovators. If you're not familiar with KB's work, but are interested in finding Buffett-type businesses in Asia, I would greatly recommend you get in touch with KB. He's also working on a Best Idea report, a monthly report, which should be coming out over the next few weeks. So stay tuned for that launch, as that will be a monthly presentation of KB's best wide-moat ideas in Asia. Today, KB will present one such wide-moat investment idea. It's his best current idea. It's a Korean company with a market capitalization of about 650 million US dollars. And with that, KB, the floor is yours. Go ahead, please.
Thank you, Oliver, for the kind introduction. Hi, everyone in the Wide-Moat Investing Summit 2013. The Bamboo Innovator is honored to be presenting to you our topic. Wouldn't it be nice if we can invest before the wide economic moat is obvious? Some of you might be wondering, what is this Bamboo Innovator about? Bamboo bend, not break, even in the most terrifying storms or devastating earthquake that would have snapped the mighty resisting oak tree. It survives, therefore it conquers. Because we find that disruptive industry trends and black swan crisis have become like a permanent fixture in today's marketplace, from Portugal to China, local government financing crisis. So wouldn't it be wonderful if countries, companies, and even individuals can stay resilient amidst the disruptive upheavals and unorthodox challenges like the bamboo? Because there are like about 15,000 stocks in Asia Pac ex-Japan, under $1 billion, 80% of this are under $1 billion in market cap, and the median market cap of these companies in Asia are around 80 million US dollars. So most of these companies, as we now discovered post-financial crisis, they are often manipulated by insiders and syndicates, and they are like outbreaks of accounting frauds, governance lapse, asset expropriation erupting on a systematic basis at the firm level. So how does a long-term value investor go about investing in Asia to generate the sustainable upside returns? So if running quant screens to filter out this 15,000 stocks in Asia doesn't work anymore, given the governance risk, so what works? So hopefully, we hope that this Bamboo Innovator framework will be useful to value investors to adopt and adapt the Buffett-monger evergreen value investing principles to Asia. So in the recent Berkshire 2013 AGM in the Q&A section in the afternoon, I recalled that there is one particular question asking Buffett and Munger how they view investments in the emerging markets and what kind of companies they are interested in. So it is an exciting Q&A session. And Buffett said that emerging markets aren't their specialty. So if you were poor enough, you might even consider doing that. So Munger quipped, it's a great way to sell investment advice, something in every category. Lots of commissions, lots of advice, lots of action, shifting of assets around to generate fees. So Buffett said about whenever you hear people talk about concepts, country by country ideas, they're better at selling than investing. So Munger, in his usual dry humor, he said, our experts really like Bolivia. So you say last year you really liked Sri Lanka. So Buffett ended by saying, we usually think that it's a lot of baloney. So in this presentation today, I'll be presenting to you, as Oliver pointed out, a company that's listed in Korea with a market cap of about 750 million US dollar. It's a bit like, in terms of business model and its Wide-Moat so-called category, it's like Buffett's flight safety, the flight simulator that they bought. in 1996 in October for 1.5 billion. So they have got similar business model, and we'll see in a very short while about this. But before we go into understanding in depth about the stock idea, I'd like to just briefly discuss the background of Korea itself, given that it's a Korean company, because most people associate Korea with the halo effect of Samsung. You know, it's like the poster boy and darling stock of Asia. So, and it's like the hardware, and then PSY, the Gangnam Style, is like the software. So it's like when you assess these two, put them together, and you look at the PE at the aggregate level for Korea, it seems cheap, particularly when there's punctuations like the Pyongyang, the North Korean nuclear crisis on and off. So everyone usually, you know, they think that Korea is cheap, but if you really look into the individual stocks itself and not look at the thematics that Buffett and Munger warn us, Korea has several death arrows, because most of the average corporates in Korea, they are not like mini Samsungs, and there's overly high expectations of growth and quality for them. And then there's the Shabo, which is like the conglomerate governance risk, where expropriation and embezzlement is made easy from their complex circular shareholding structure. So most value investors are investing from afar. They tend to neglect and overlook this very critical risk. And then there's a debt time bomb. The total debt of Korea, if you include the household, corporate, and the government, is almost 300% of the GDP now, exceeding the previous Lehman peak and the previous 1997 to 98 Asian financial crisis. So back to the earlier question, which is a title, which is, wouldn't it be nice if we can invest before the economic mode is obvious? Because since Buffett gave us the wonderful analogy and metaphor to assess companies which can be compounders, I think there are many subsequent research, like from Morningstar, the nice chart on the right. So they actually categorize modes into 5 particular descriptions, from intangible assets, switching costs, network effects, cost advantage, and efficient scale. But I find that when you apply this to Asia or even to elsewhere, there is a key challenge, because most of the time stocks are categorized into modes after they become obvious. So let me illustrate using several quick examples to show what I mean. So just like AD and AC, right? So there's before mode and after mode. So before Amazon has an economic mode, you know, it almost went bankrupt, as you can see on the lower graph below. So somehow, after it pulled through from one of the tipping point, people start to categorize Amazon as having an economic mode, which is the network effect, as in the more buyers and sellers join the Amazon network, the more valuable the network becomes in an exponential fashion. So at that time, before Amazon has the mode, it had a lot of high fixed costs, and sales were not very satisfactory, in the sense that it can bring down the break-even point. So they almost went bankrupt in 2001, and they had to lay off at that time 15% of the employees. So let's look at the tipping point number 1 for Amazon after mode analysis. So April 11, 2001, one of the mini tipping points at that time was when they took over Borders' online book selling operations. So you can see since April 2011, the stock is up 2,500%. But this is not the major tipping point yet, in my view. So it's still not so obvious, because even if they took over Borders' online business, while it alleviates a lot of risk, that a bigger, more resourceful company can just obliterate them. It's still not obvious that they can be a going concern. So in my view, the next tipping point is the most crucial one. On August 27, 2002, when Amazon embarked upon a strategy of broad discounting and free shipping for purchases above $25. So since then, the stock is up 1,700%. So if you were to go into Google and just type Amazon and economic mode, you can find most of the so-called the links. They come mainly in the years of 2007, 2009, but not before. So they associate modes with Amazon from 2007 onwards. So you would have missed quite a fair bit from 02 to 07, because in 07 it's about 100 in terms of per share price. So when they embark upon this free shipping strategy, it sort of built trust and support in the community of the users, the partners, and the suppliers. So it's like a virtuous cycle in the sense that sales dramatically increase and fixed costs investments in all these warehouse and fulfillment centers, they started to not only break even, but to be so much profitable, decreasing the operating leverage and risk associated with this high fixed cost. So this is like Ray Kroc's admonishment when he lambasted analysts back then for labeling McDonald's as McProperty, because he's trying to say that even if you have got all the good real estate location, they are just funded with debt with high fixed costs if you can't sell burgers to earn the cash flow. So one of the key ideas from this, which I'll go on to tie it with the Bamboo Innovator Framework, is this indestructible intangibles, the trust and support from the community of customers. So let's look at Microsoft quickly. So when Microsoft had the mode, it is categorized as switching costs, the de facto standard, right? But the tipping point was on May 22nd, 1990, when they successfully launched Windows 3.0 that puts the computer in every home. And since then, as you can see from the chart, the before mode and after mode this particular event, when they launched Windows 3.0, is critical for value investors to really take note. So before mode, the stock is up 840%, but it's still like a company that doesn't have a serious product that can really dominate globally. So after mode, if you look at the stock, since May 22nd, 1990, the stock is up 3,600% when the mode becomes obvious. And again, if you type Microsoft and mode, it starts to be more obvious, starting, 98 period. So, but if you were to go into the history of Microsoft, it's not so obvious even for them, because Windows 3.0 is an aborted project, and it's a project that Steve Ballmer aggressively lobbied to have it killed off completely because they were working with IBM at the time. So Steve Ballmer's idea and thinking at the time was that if the company sensed that Microsoft might keep working with the Windows as some sort of hedge, they would have put that in their partnership. So they wanted to kill off this Windows 3.0 project. So it is the culture in the early days of Microsoft that allowed mid-career engineers like David Wise to really, work on innovations from the bottom up. I've elaborated this a little bit in our article at Beyond Proxy, so do take a look. Thanks. So there's a difference between catalyst and click moments, which is like tipping point in the examples above. So it's like for fund managers, because we're always under pressure to deliver short-term results, so we often ask the sell-side analysts or the management any upcoming catalysts. But this can be quite misleading when you do not understand the scalability, the resilience, and the wide moat of the business model, because a lot of these catalysts, the corporate news announcements of sexy projects or M&As in Asia in particular, they are false signals created and released by insiders to inject action into the stock to lure investors in, and then they are offloaded in a pump and dump cycle. So in the Bamboo Innovators framework, serious institutional investors spend most of their time not in looking at stock price strings or gaining insider knowledge of catalysts, but really in analyzing this wide moat business model dynamics with tipping point events so that they can literally hear and see the clicking sound when they occur to produce a resilient compounder. So there's another folksy way that Buffett gave us to look at what is exactly wide moat. Remember the marriage test back in the 1970s that he wrote in his shareholders letter? I think that's 1978. So he said Tom Murphy and Don Burke of Cap Cities, which is now under Disney, they're not only great managers, but they are precisely the sort of fellas you want your daughters to marry. So drawing from this wisdom of Buffett's marriage test to assess management quality. So how about a folksy way to look at assessing the quality of the moat? So in our view, it's like, would you be happy and proud for your children if they work at at the company? So it's like the children's test, because just like we want the moats to keep widening, no point stagnating, right? Where there are reinvestment opportunities at attractive rate of returns. Parents wish for their children to grow from strength to strength, to withstand the shocks of the bumpy roads in life, to compound value resiliently even in crisis period. So that brings us back to the Bamboo Innovator framework, whereby the key quality that value investors should look out for is resilience. So Buffett gave us, in my view, this particular wisdom that I feel isn't highlighted enough or emphasized to more people, which is he said, if you gave me 100 billion and said, take away the soft drink leadership of Coca-Cola in the world, I'll give it back to you and say it can't be done. So what is Buffett trying to say here? Buffett is trying to say that maybe the tangible assets isn't the sole criteria for the intrinsic value to shine out. So I like to push Buffett's idea even further and even deeper, which is how about burning and destroying all the tangible assets? Is such a company worth anything in the eyes of a value investor? So in the case of like Germany's Bosch, which is the industrial giant, widely respected in Europe, that's worth 150 billion. If you burn down all their assets, they still worth 150 billion. Because back then, during World War, all their factories and plants are destroyed with no tangible assets left, but they're able to bounce back and scale from scratch with resilience to create a 150 billion industrial giant, because they had this intangible quality, be it from their inventions in their magneto-ignition device that's found in almost 80 to 90% of vehicle engines globally, as well as the trust and support it had back then, because it's known for its quality of products, its innovativeness. So be it the customers or the suppliers or the financiers, they're all willing to support even though they have no tangible assets back then when they were destroyed. So this is the mental model of the Bamboo Innovator framework, whereby the RES, which is the acronyms for the first three words of resilience, it stands for rootedness, emptiness, and chef. Rootedness is rootedness in a culture of kindness, trust, cooperation to allow and foster for innovation. Emptiness, there are three particular sources, the indestructible intangibles, a core periphery network, which allows for decentralization of decision rights and empowerment through technology, and three, which is the open innovation business model. I've elaborated on this in the various articles in Beyond Proxy. And then chef is like the chef leadership, whereby it's an unorthodox leadership which allows for unpopular, unconventional voices from the bottoms up to voice out their opinion, to allow innovation to take place from the ground. So assessing the 15,000 stocks in Asia with the Bamboo Innovator Framework, I think that's very critical because, in my view, a good to great checklist would overlook all these resilient bamboo innovators because they are nicer, taller, more impressive, bigger trees in the forest, whereas the bamboo is so small, thin, and fragile. So in particular, the empty hollow center of the bamboo makes it unique amongst all the trees because with this emptiness, this hollow center, the nutrients and moisture that could have been exhausted maintaining this center, if it's solid, it can be utilized to grow other shoots and stems. So from the builder's viewpoint, the architecture of the bamboo is a powerful configuration. Fibers of the greatest strength occur in increasing concentration towards the periphery of the plant. So with this such methodology for bamboo innovators, with this emptiness and business model by these three sources, in the longer term, Bamboo Innovator hopes to develop a Bamboo Innovator index product. In a way, it's something like the Morningstar Wide-Moat ETF, but the Morningstar only had 20 stocks in its ETF product. So with this so-called Bamboo Innovator framework, from the 15,000, you're able to winnow down to a watch list of 550, and from this watch list, most of the stocks that are frauds and misgovernance or value traps, they are eliminated. So it's an unusual screening process whereby it's a combination of quantitative and qualitative criteria that's proprietary and unique to the Bamboo Innovator. And then from this, it's another screening to a list of about 270 Bamboo Innovators. So it's not just in Asia, but it's applicable in US and Europe. And I've done up in a previous presentation on this in the Emerging Values Summit and on the Beyond Proxy website to discuss more about this earlier. So do check it out. Thank you. So let's go back to Korea. In the watch list, there are about 70 of these Korean bamboo innovators, which are not so much, which doesn't have much of a governance or value trap risk or accounting frauds. So the Korean market is the 13th largest in the world, with a total market cap of about 1.2 trillion. So this is like a snapshot of the 70 Korean bamboo innovators by the market cap, the sector, the daily liquidity, and a simple price-to-book ratio, to just have let you have an idea where they populate. So quickly, we go into some background about Korea that a Korean will never tell you because they are very proud of their country. So, I'm going to discuss some of the lesser known aspect about Korea, the dark side. So there's a mighty Korean shables and the Samsung halo effect, whereby the local saying is that a Korean president lasts for 5 years, but Samsung's power is forever. So the top 10 shables or the conglomerates accounts for more than half the value of the 1,800 companies listed on Korean Stock Exchange. So the 30 largest shables account for over 80% of the South Korean exports. And this shable so-called policy was in fact a national policy adopted by the late military strongman and president Park Chung-hee back then to kickstart a poor economy back then, and which is now grown into Asia's 4th largest. But yet, even though the shables are visible and well known, but they've got this corporate governance discount that is well known as well to long-time investors in Asia, whereby they have low dividends. Typically, there's a lot of embezzlement, tunneling, and expropriation risk that is made easy because try looking at their shareholding structure. You'll be definitely surprised at how complex and circular that can be. So they're able to use a lot of artful accounting, merry-go-round or money-go-round transactions via related party transactions to simply expropriate all the cash that you are able to see in your quant screens. So it's in your quant screen, but it's not actually there in the company. So this is what happened during the Asian financial crisis that Western investors discovered to their shock. So you can see there's been a sharp decline and a lot of recent cases of powerful Shebo chiefs from SK Holdings, which is the third largest Shebo in Korea, who is jailed for accounting frauds finally because he was pardoned earlier before the recent Lady President Park took over. So and there's this Hanwha chairman who was jailed as well for embezzlement because they treat it as their personal ATM machine. All these powerful tycoons. So there's the spectacular failure of Daewoo in 1999. People never thought it's going to happen again because Asia is supposed to be, and Korea is supposed to grow stronger, right, and wiser from all the crisis. But last year, recently, Wong Jing, one of the very popular darling stocks of Western investors, it went bankrupt because there's a lot of hidden debt risk in the entire group. And then recently, only last month, the CJ Group, which is sort of related to Samsung, it also came under sort of so-called embezzlement problems, whereby the founder and the chairman is now under prosecution and in jail. The trial is still on. So yeah, all this massive hidden debt, and it's really something to be very cautious about. And we should not be just looking at pure quant, low PE, and all these metrics, because even the Korean Sovereign Wealth Fund, which is the 350 billion National Pension Fund, they have been propping up a lot of all these big Shebos from Samsung, Hyundai, SK, and LG. You can see they have went up 4 times in the past 6 years. And then there's a potential great Shebo restructuring ahead under the new Lady President Park. In particular, I'd like to highlight Samsung and what it means for the value investors. So essentially, it's saying that a lot of all this unwinding of this complex circular structure will mean that all the previous propping of the share price or volume or the profits, they might not be as easy as before. So do be wary about investing in visible, popular Shebos in Korea. So there's the concern about Abenomics in the short term as well, with yen hitting Korean exports. So from Buffett's POSCO to the Korean automakers like Hyundai and Kia, they have been witnessing declines in their exports compared to the Toyotas and the Japanese automakers and steel makers. In the first quarter, most of the results are quite bad for these Korean companies. So back then, if you do recall, in the Lehman crisis, there's this Kiko knock-in knockout FX options. So a lot of small, medium enterprises, Korean companies, they were trying to hedge against a rising won through all these derivatives, and then it turned into heavy losses as the Korean won fell. So it's a lot of all these smallish companies love to speculate in derivatives. So do be wary in terms of the capital allocation decisions. So we need to go into their footnotes to really investigate. So the long term, if you look at the KOSPI versus the cross of the yen and the yen-Korean cross currency, you can see that perhaps maybe a stronger won could be better, and the winners, in fact, are those with the pricing power, both domestically and overseas, because of their unique business model or some compelling products and service offerings that they have. So if you look at, again, Korean productivity is ranked 28 out of 30 OECD nations. So much for innovation from Korea, right? So this is something that Koreans will never tell you. So the Shabo dominance actually stifles the bottoms-up SME entrepreneurship innovation. So beneath the Korean glitz and glamour, there's massive household debt to buy Chamyeon. Is like face. You need to keep up with the Jonases and a certain lifestyle. So it's a society built on credit cards. It's increasingly worse. So it's like the impossible country. There's even a book about that. The pros and cons that I highlighted. You can see that I've deliberately, or not deliberately, it's a matter of fact that there are more cons than pros, right? But the pros about Korea, their willingness to change and ambitious desire to globalize a business is something that I feel it's particularly meaningful for value investors to really find the Wide-Moat businesses that emanate from proprietary technology, the indestructible intangibles, appendix, like some of the Shabo origins. Thank you very much. Hope to be able to present to you more ideas in the future.